But before we really run a backtest, we want to do some more statistical type analysis. And let's just take, for example, something like the MACD. It's a fairly straightforward indicator. And now one thing you can do is you can take this histogram and you can say, okay, if my, you relate basically the histogram to the returns that you would achieve trading the direction of that histogram. And instead of just using one entry or one exit, you can actually do this for every single time step in your data. And so what that gives you is basically a continuous signal output. And then one thing you can do is you can correlate the signal strength, for example, to the returns that you would have achieved with this.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field.
Ladies and gents, welcome back to the Algorithmic Advantage. Today, part 2 with Dr. Thomas Starke. If you haven't seen part 1, of course, that's essential, where we really created the foundation and the introduction for Tom's pipeline, his process for building robust trading strategies. And that's such a critical part of it. We're going to really deep dive that in this particular episode. So go back and watch the first one, links below. And don't forget, of course, that if you like the cut of Tom's jib, if you like what we're talking about here, then Tom is going to be doing workshops, going through all of this in detail, using Python, very practical, in the Algo Collective community. Check that out on algoadvantage.io/collective. And we're really looking forward to everything we're going to be doing in that community and being able to lead others through this process, build up your knowledge and skill, capability, give you a better understanding of the tools that you can use, how to use them. And of course, the objective really is to build this pipeline and this process so that we can build robust trading strategies in an efficient manner and have some confidence in the results that we're producing. So, Tom, thanks for being here once again.
Thanks, Simon, for having me.
Looking forward to it. So if we just continue right on from where we left off, in this second half, I really want to focus on your process, right? So This is critical to the entire systematic trading endeavor, that we want to be grounded on a sound quantitative platform, as you've said to me. I really like that expression. We want to be able to think like an institutional quant. We want to have a statistical framework in our mind. We don't want to be misled, so we certainly don't want to overfit and trade something that's nonsense, that falls apart out of sample. All of those things that are so critical and sometimes so not intuitive, especially to the newer trader. So enough from me. Tom, what I guess I'd like to start with is just, where do we start? What are some of the foundations for getting our thinking right to establish a process for, to establishing the right process and pipeline for building robust strategies and a robust portfolio?
Well, I would say that the first thing that I really start seeing already with some of the students and retail traders is that they don't start with the very first essential thing, which is realistic expectations. When you get into this, you gotta be realistic of what you can achieve, at least to start with. And there is often, and I see this, is this interesting assumption or hope that you will find this perfect strategy that just creates 100% profitable trades. And this is just simply not realistic. Even if you see that the trades are quite profitable, when you actually look at the market structure, and some people reckon it's called a fractal structure, you will see that whenever you have movements up, you have movements down also. And even in a profitable trade, most likely you will have some sort of drawdown inside that trade. And so while you may end up with a positive realized profit, you still have to go through some level of drawdown. And what that means is that being realistic is a good starting point. What? Because you say, well, I may make profits in the market, but I have to approach it in a way where I manage my risk, where I manage my expectations, my drawdowns, all the things that come with trading. I think this is really important. And so we're not looking at perfection. We're looking at robustness and liability. And coming in with this mindset makes already a huge difference, because frankly, you see a lot of people and they're just sitting there thinking they need to find this perfect whatever indicator or trading signal that gives them this 100% win rate. And coming from such a starting point, you already half defeated yourself. So I would say just coming in with the right mindset in relation to that makes a big difference, and it's actually a positive to not be overly optimistic. The other thing I should say is often people come in and they're focusing on a single asset and a single strategy, which is definitely a good idea to start with. But really, it's nice to from the outset to, in some sense, have a broader view of what is possible, what asset classes, what strategy types you could potentially trade, how you could diversify in various different ways, and so manage your risk in various different ways as well. So it's really important as you come in, really define your objectives, create realistic expectations for yourself. I know this is actually quite hard to do, but it's really helpful. And then just remember, there really is no free lunch in trading. There's always you pay for everything you do with something else, but that doesn't mean there is no lunch. There definitely is. You just have to be very clear on what that will be.
It's a huge advantage just to start the ball rolling, knowing and having been told that your first strategy is not the end goal and that you are going to ultimately build a portfolio. And one of the things I love about systematic trading is that, unlike a lot of discretionary traders who really can only focus their attention and their eyes on one strategy at a time because that's taking all their attention, our edge, if you like, is that we can deploy multiple different strategies. So we have to be mindful that that's where we're going to get to, even if we haven't started there, and that we know that as we build out those strategies, we're going to be reducing our risk, reducing our bet size, increasing our diversification, non-correlation. So I think it's a fantastic point. I guess we also, at the outset, then often have to make a few practical, hard decisions that come into our process around the asset classes, timeframes, markets that we'll trade. That's another aspect to it, correct?
Well, absolutely. I mean, everyone is also different in that way. In some countries, certain asset classes are just simply not available. The other thing is, if you decide, for example, on your asset classes, you want to make sure that your counterparty risk is limited, because you remember people trading on FTX or Mt. Gox, the exchanges collapsing. And despite people seemingly being profitable, they actually lost all their money. Is something that is really important to understand as well when you get into this, because that can really, even though you are very successful as a trader, they can really break you. Even the choice of your broker could be a problem. If the broker is somewhat dodgy, you can end up getting losing everything through your broker and so on. So there are many many considerations here. I also just wanted to point out from our previous point, you may have heard of the golden rule of active portfolio management by Grinold and Kahn. That basically says the information ratio, which is our performance, equals the information coefficient times the square root of breadth. And the information coefficient is effectively the smarts that we have in our trading strategy. So how smart are we? So if we were like super smart and we make 100% win rate, literally, then we don't need any breadth. We just put everything in one strategy and that's it. But and most likely we're not going to be that smart. So in order to actually increase our performance, what we want to do is increase our breadth. So increase the perhaps number of strategies we trade, the asset classes we trade, and so on. And so that doesn't scale quite as good as our smarts. So it only scales with the square root of the number of the size of our breadth. But nevertheless, this is a big advantage. And especially, and coming back to this, if we are systematic and automated traders, that makes our life much easier because we can easily scale in terms of breadth through automated trading strategies without really much downside. I mean, we have to manage that a little bit, but compare this to a discretionary trader, the breadth of a discretionary trader will always be very, very limited. And in our case, it can potentially be unlimited. Of course, it's not quite that simple. You have to look at the availability of your fund or how much money is available to you. Again, the availability of the asset classes and so on. But this is in fact one of the really strong reasons why we get into systematic and automated trading, because we can actually really improve our performance by a relatively simple means.
On the skills side of things, I do believe too that a good process is going to encourage the development of our skills, because it's going to the skills that we need to develop as systematic traders, include things like better understanding the tools that we're using, better able to use those tools, and ultimately to conduct better and better research. So
yes,
want to
absolutely.
hit that formula on both sides. All right. So look, I think that's a nice framework or a foundation to set the discussion on. As we said last time, the right thinking really helps us come out of the gates a lot quicker. We're going to use the right skills. We're going to use the right tools for the right tasks, and so we want to build up a process around that. And just on the timeframes, I guess, Tom, we mentioned getting, choosing markets and choosing timeframes. Is there anything else that you can add on getting that time frame right? Because I was just thinking as well of how many traders are lured early on into trading very short-term FX against a really dodgy FX broker, that kind of thing. So what are some of the considerations around time frames that we're trading?
Well, first of all, your trading costs are not going to get smaller as you trade more, or well, a little bit perhaps with some brokers, but you can safely assume that generally they don't. So the more you trade, the less, or the higher your trade frequency, the less expected profit per trade do you have. And then considering that your trading costs will still be the same, more or less, that means that your higher trade frequency, actually, you need a lot more edge to have the same outcomes. Otherwise, it's very easy if you have too much turnover for a trading strategy that actually has very good signals to still not be profitable, because we're getting wiped out by the costs. And so your time frame is in many cases really a function of the feasibility of that time frame with respect to your trading costs. But there's a few other considerations as well. So, for example, often markets work differently on different time frames. Let's take the US market, like the S&P 500, for example. When you actually do a statistical analysis, you will see that in the short term, this market has a mean reverting property, and in the longer term, it's got a trending property. So depending on your time frame, you may actually want to trade that market differently, a different set of strategies. So there is quite a few considerations that come into the time frame, and that should also be part of your research, looking at the time frame and then looking at what you're trading, understanding what these assets that you want to trade actually do on different time frames, and then making some educated guesses of what might be the best strategies to tackle those time frames. So I think it is very important. It is, however, not a bad idea to decide with reasonable confidence on a time frame beforehand, taking some of these considerations into account, because once you set up a research pipeline and then you really want to change your time frame by a lot, then suddenly it may be very difficult to keep that pipeline. You may have to redesign everything you build. So having a good understanding beforehand is usually very useful.
Yeah, good point. Okay, Tom. So just to now go a layer deeper, I guess, into thinking about the right way to do research. Take us from the top. Like, what are some of the proper principles? What are some of the things that people get wrong right from the outset when they consider that they're doing research to building a robust trading strategy?
Well, I guess first of all, you got to understand that what you're doing really in trading is you're running a business. So however small that business is actually a business, and a business consists of various things. So if you have an engineering business, you usually have a research part and an operations part and a production part. And of course, the nice thing about the business of trading is that you don't have marketing and generally no customers. And that is something that makes the business of trading quite attractive to a lot of people, because they don't have to deal with, especially if you're more inclined, like numerically inclined, you don't have to deal with clients, you don't have to deal with all the things that makes most businesses out there, which is really nice.
Yep.
And so, as you probably know, that most successful businesses actually also conduct a lot of research, and when businesses start to slow down on their research, they will often also go down the hill a little bit. This is quite common in generally in the world. So we really want to make sure we have a really good research department in our one-person business, perhaps, or however many people you are. And one of the things we research is that it's generally costly, and even for oneself, it's a big cost on time, on mental energy, even on costs for data sets, tools, and so on. So if we do research, one of the interesting things that we can do is to really limit the amount of spend and time and resources, is to systematize and automate wherever it is possible. So we really want to try to conduct very good research, but at a manageable cost to ourselves and to our wallets. And how do we do this? This is really, I guess, what we're going to be talking about for the rest of this podcast. So let's just start with a high level. First, we need to ask ourselves, where do we want to go in our research? And this relates to our investment or trading objectives. We've talked about this in the previous podcast. Where are we in life? Even our age is important and really determines how much risk we're willing to take, how we run the strategies. Of course, our intellectual capabilities play a bit of a role there as well. Sometimes you are very the super smart people. Sometimes they trade very complex mathematical structures, and someone who's maybe not quite as mathematically inclined trades more simple things. Now, what I would really like you to understand is that, in my opinion, at least, there's absolutely no need to be extremely smart. I noticed this myself. I think when I started trading, I came in trying to be a bit too smart, to be honest. And it's not that I dumb things down, but I really simplified a lot of what I used to do, and actually find that the simpler things are often the more robust ones. But simple doesn't mean trivial. Simple means still well done, well executed, and so on. So we really need to understand this. Then we need to somehow have a method to generate or research and generate trading signals, obviously, because trading signals are somewhat of the bedrock of our trading. Without signals, nothing is going to happen. So we need to have a good data source. We need to have some pipeline where we potentially clean and manage our data effectively. You know, if whenever you try a new research and you spend several hours perhaps going through the data and cleaning them again and again, that may not be so efficient. That may cost you a lot of time. So we need to somehow see if we can automate these things. And then, of course, we come to the analysis of our trading signals. So we, first of all, get the data, we generate some trading signals, and they could be some mathematical formulation which we have programmed. And we want to know how good are these trading signals. And here's an important point that most people might not understand. What we're doing here is still a long way from doing a back test. So a lot of people come in, they just buy a backtesting platform, and then they just run backtest after backtest after backtest. And at some point you find something that looks good and you run it. I mean, with all respect, this is not a great strategy, just simply because you most likely will overfit. Because if you try long enough, eventually you will find something interesting. But there is absolutely no guarantee that this will actually hold going forward. And there are a few things with backtesting, and I already mentioned this previously, that are a little bit problematic. One is first assumptions any backtesting engine makes, such as costs and so on. And there's also this idea of having path dependency that can actually be problematic. We'll talk about this maybe a little bit further down the track. But before we really run a backtest, we want to do some more statistical type analysis. And let's just take, for example, something like the MACD. It's a fairly straightforward indicator. And let's just assume, we take the MACD histogram. And for those of you who don't know, it's called the moving average convergence divergence. And the histogram basically is either positive or negative, and it depends on where two moving averages cross. So if they cross one way, it gives you positive signal. If they cross the other way, it gives you negative signal. And now one thing you can do is you can take this histogram and you can say, okay, if my you relate basically the histogram to the returns that you would achieve trading the direction of that histogram. And instead of just using one entry or one exit, you can actually do this for every single time step in your data. And so what that gives you is basically a continuous signal output. And then one thing you can do is you can correlate the signal strength, for example, to the returns that you would have achieved with this. And if you do a correlation with the two, you probably know a linear regression, simple. You can actually see how predictive that signal may have been. And that in turn will give you a good understanding of how valuable that signal actually is, whether it has any merit or not. And so if you can see that the signal is basically more or less random, then you may want to discard that straight away, because you go, okay, what good is it if I can't see any predictiveness in that signal at all? And then you just move on. And if you think, well, there has to be something, and your statistical tests basically tell you, well, there isn't really anything, you most likely are going to waste your time. Interestingly, I talked about the golden rule of active portfolio management before. When we take these correlations between a signal and your strategy performance or strategy returns, that's called the information coefficient. So the correlation between this is called the information coefficient, and this is actually the skill bit of your equation. The performance equals the skill times the square root of the breadth of your strategy. So if you get a good value there, you can really boost your strategy quite a bit. And if you can do this multiple times by increasing the breadth, it's even better. So basically doing this beforehand, and this is just one of the things you do in research, you can already make a huge impact, and you can weed out a lot of things that are not necessarily interesting, or you can just discard. And then, of course, once you've done this, you can then go, okay, well, I want to combine my findings somehow. And the combination, again, is another bit of research. There's many ways to combine different signals. There's many ways to combine different strategy performances and so on. So, one of the ways to do this is to use a correlation or covariance matrix, where you basically look at all the correlations of all the strategies with each other. And then based on that, you actually size your signals. And so you can already get a sort of signal weighting before you even start running any backtests. And the good thing with that is, first of all, it's much, much faster than running a backtest. And once you have it, because it is so fast, you can actually try a lot of different ways of doing it. Once you're actually running the backtest, usually it will be a lot slower to do that than doing the research in advance. And this comes back to systematization and automation, and ultimately cost and time saving. So
I love it. That's such an important point, Tom, and it's one that people can get started on right away. Just the idea of doing statistical analysis first, upfront. It's not about building the backtest. Take your idea, take your signal, do some statistical testing on it without the path dependency of the single path of that backtest. I want you to go into more detail with that, but they can use their existing set of tools to already get going with this. And it is a problem I see everywhere myself as well. And I think it's foundational. And then that second point that you raised, that you can really start to, build that strategy with purpose right from the get-go, because you're looking at the statistics, you're looking at the numbers, you're looking at correlations. You can start to hone in on exactly what you would like to draw out of that research and make that into the strategy. So you're building based on logic and reason and the scientific method from the outset. Critical. All right. So if we just deep dive that a little bit further, I guess I want to get into this pipeline that will allow for this methodology to flower. So take us through, I guess, some of the bullet points of step 1, step 2, step 3 in what this pipeline would look like. I mean, I know we can only cover it at a high level, but let's talk about some of those things that you've already mentioned.
Well, so first of all, it's good to have a pipeline. It just simply makes things a lot smoother and a lot quicker. The other thing is the question of what is your pipeline based on. So obviously we all have different starting points, and some of us, obviously it's got to be some type of numeric analysis tool, and most people are familiar with Excel, which is I would say the basic tool, but not necessarily trivial as well. Excel, I have seen some very powerful things coming out of Excel, which is really amazing. And some people are like real wizards in it. And then probably the next level up will be two tools. One is R, which is a purely statistical framework. It's kind of a programming language, but very much geared towards statistics. And it's actually got a lot of financial functions in it as well, which is really great. And the other tool is called Python. Most of you probably know about it. And some people say Python is the new Excel, which is probably true to some extent. It's a sort of Excel on steroids. It's different from R in some respects, and they both have their pros and cons. In terms of versatility, Python definitely beats R in many ways, because if you do R, you can really focus on statistics, whereas with Python, you can actually do a lot more with that. And it's just a little bit more tricky to do in R ultimately. So, once you converged on your platform, effectively programming, then what you want to do is focus on developing hypothesis. We call it hypothesis in science, which is basically ideas for trading strategies. And so you say, well, maybe this combination, this indicator, will produce a profitable strategy. So the first thing you need to do is test your hypothesis. And usually this is done by reasonably straightforward statistical tests. And one of them I've already talked about is just simply a regression between your returns and the trading signals, or the trading signals and the returns. And so once you got this, you can already say with some confidence, oh, the signal that I produce or the strategy that I create, which is really the same thing, has some predictability. And in hypothesis testing and stats speech, say there is a hypothesis and a null hypothesis. Usually the null hypothesis is that the strategy is not profitable. And if you see some profitability, you cannot say that the strategy is profitable. But what you could do is, speaking statistically, you can reject the null hypothesis that the strategy is not profitable with some confidence. I mean, it's a handful, but it's nice sometimes to know the distinction.
Yes.
So all of this again is really done long before we even talk about a backtest. And one of the really good things there is also that it avoids this path dependency that often backtesters introduce, where you effectively got a trading signal and then you trade it until you get some sort of exit condition. And when there's other signals in between, you just discard them until you exited. And you don't, and it means that if you start from a different point, the strategy may give you completely different results. And you just really want to avoid this. And so it's really great to it's really great to have these other tools at your disposal that give you a much clearer idea straight from the outset whether the strategy has some merit or not. And I really want to drill this. I really want to emphasize this. It's to do it like that is way clearer than running multiple backtests with lots of parameters. Not a single one of them may actually give you the real story. And it gives you some part of the story, but most likely not even the most important part. So that's really very crucial, I would say. And then
it is so crucial. Can you just deep dive a little bit further? Just explain to people what this path dependency is, what the issue is, just to make it painfully clear.
Well, it depends a bit on the backtester you're using, but the typical backtester is where you have an entry condition and an exit condition, and in many cases they're different. Unless, let's say, you use a moving average crossover and it crosses one direction, you go long, and across the other, you go short. Also, oftentimes, let's say you have an entry condition and then you have a stop where you say you hold for so many periods and you exit, or a profit take. And basically what can happen is, let's say you've got your entry condition and then you got a profit take and a stop loss. And before these trigger, you may get another 3 or 4 signals happening in whatever direction. And as you backtest with your backtesting engine, the backtester will just simply discard these conditions because it's already in a position. And so, your first signal may be profitable and come out profitable, but had you started just a little bit later, you may have had a different signal. Maybe you start with a long signal, but then you would have triggered a short signal, and you may have perhaps lost money. Whether or not is not the issue, but what it means is that just starting at a different point can often give you completely different results. And this can really be problematic because you cannot actually trust your platform to give you a good picture of how your strategy actually performs under different circumstances. And that can be a real problem. And it truly is for a lot of people. They just always start at the same point. You switch it on, go, oh yeah, positive. And that's the end. And then start deploying it and wondering why it's not working. Maybe if they had deployed it one day later, it would have been really well. It would have done really well, but because they deployed early or whatever, it's not. And so coming in with a much more sound process before you even do the backtest is incredibly helpful. And as I said before, the backtest should really just be at the end of the pipeline, or at least the full backtest should be just at the end of the pipeline, basically confirming or rejecting all the work you have done before. And ideally, if you conduct good research, usually it would confirm your research that you have previously done, if it was good enough. So too much emphasis is often placed on just running these backtests. And
that's going to naturally lend itself to being in a process, that's not overfitting by design, isn't it?
Not really. You can still overfit quite a bit.
Yeah.
So you have to be very careful nevertheless, because the interesting thing with those more statistical tests is they're generally incredibly fast and they're very easily automated. And you can run these basic, say correlation or regression tests. You can run 10 a second, let's just say, for the sake of the argument. So you can run 36,000 in an hour, and somewhere in 24 times that in a day, which is a huge amount. And you could try this with all these different parameters. And if you then go and just pick the best, you're most likely not gonna. It's not gonna be
Fair
a winner.
enough. True. Yep. You can still fool yourself. Yep.
So overfitting is clearly one of the most problematic things in this whole process. And the reality is that it's almost impossible not to introduce some sort of bias or overfitting just purely by looking at a market, at a chart, or by knowing that, I don't know, let's say Nvidia has gone up for the last few years. That already introduces a bias. So it's actually quite hard to completely eliminate it. There will always be some residual bias in your work. However, you can at least really put a lot of effort into minimizing it as much as you possibly can. And that's a worthwhile thing to do, obviously. And there's many techniques that can help you to do that. Maybe that's something we can talk a little bit about later. But
I guess go on.
Yeah, go for it.
Well, I guess the thing that I was thinking there, as you were saying that, was that if someone starts with a back test and builds a single back test that looks good, everything that you do thereafter is subject to that initial curve fit. You could take those trades and play them in a different order and do Monte Carlo or whatever, but you started on a shaky foundation, so it's garbage in, garbage out.
100%. It's really not a good way to do things. And one of the things that you could do, for example, is to if you do these tests, you could vary the parameters in a reasonable way. Obviously, there's some parameters that don't necessarily make sense. But if you vary your parameters in a sensible way and then look what's coming out of it on average or what the distribution is, that can also give you some sense of what you can expect. Because most likely, once you actually start a strategy, then the parameter set that was ideal in that phase is not ideal anymore going forward, but there will be another ideal parameter set. And so you can't know that ideal parameter set. But if your strategy, regardless of the parameters overall, already gives you a reasonable outcome, that means that more likely the outcome going forward won't be as ideal as what you did in your research on your backtesting, but it will still hold up. And that's really what we're after. It means it's more robust. So you're really, if the more emphasis you put on that, the better your outcomes will be ultimately.
Yeah.
And the less overfitting you will end up with you having.
All right, so we've got some hypothesis testing. We're getting things in the right order so that we're avoiding risks like path dependency. So we're doing statistical analysis and research, drawing conclusions, using the likes of Python to help us with us. Okay, so what's next? We're starting to build up some research. We're gaining some confidence in a particular signal. What's next?
So the next step really is that once we have a number of signals that look interesting, we want to combine them. And combining could be as simple as just adding them up or doing something like this. But if we do this in a more meaningful way, we can often get a lot more interesting outcomes, because not every signal is equal. Some of them, for example, have more predictive power than others. Let's just use that as an example. Now, if we have a signal that has a lot of predictive power, we want to naturally weight it higher in our ranking of signals. That doesn't mean, though, that we should discard the lower predictive ones. They may still add some performance to our strategies, but we want to rank them lower simply because they're just not as good, but still have an impact. The other thing is that we may have signals that actually don't look that great at all in isolation, but if we add them to our strategy, they may just prevent those really big drawdowns in those moments that when we really need them. So if you have these strategy types, you probably have seen this, they are pretty flat a lot of the time. But suddenly when there's a big correction, they really spike. And this can often help us to effectively buffer the impact of like a large drawdown, for example. And so let's just say we had two strategies that are very similar and give us good performance. Adding them up may not really do anything. So there's just two of the same. But adding a strategy that actually doesn't look quite so good, but just performs well in the right moment, can really boost our performance a lot more than two similar good-looking strategies. So it's really important to make these distinctions and to be aware of them as you combine your strategies and as you combine your signals. It can be a very, very powerful thing to do if you do this in the right way, and not just in a sort of more or less naive way, just looking at the annual returns or something like that. Then the other thing is when you have signals, you may look at them or may have some tools that actually look at their performance at different market regimes. So perhaps you have a way to classify bull and bear markets, something like this. And then you want to see, well, are there any, let's just say we have 5 strategies, and then you find, 3 of them perform really well in bull markets, but the other 2 don't. But they may just be good in bear markets. So one of the things that is possible is to weight the strategies differently according to the market regime that you might experience. And that, again, could be a very powerful thing to do. And so it doesn't mean you switch them off completely, but you could just say, well, we just change the weighting a little bit in different markets, and then just boosting the performance of what we're doing. once we have done that, we'll have basically said, well, we combined our signals. The next thing to really take into account is turnover. So some strategies don't turn over very much. They're going very smooth, a little bit up, a little bit down, not very much. These are great because it saves us a lot of trading costs, but we may have strategies that look extremely performant in the research, but if the turnover is really, really high, then they may not be suitable. We may actually, despite how good they look in our research, we may have to discard them simply because they're costing too much money per trade. The profit per trade is too low to overcome all the trading costs that we can get. And that's very, very important. And that, again, that's something that many traders not emphasize enough. I think most people have now caught on to the fact that trading costs are a real showstopper or party pooper, but you really, really want to drill into this enough to get confidence that your strategy isn't one of those.
And of course, it's dependent on how much capital we've got to deploy, the broker we're working with. And of course, if I think back over everything we've covered in part one and here, if we're thinking about things the right way institutionally, then, because I've been up against this transaction cost issue with high turnover strategies, then we might be able to investigate other ways to harvest that alpha rather than just discarding the entire research, because we can see there's something there. Maybe we just need to reduce the transaction costs. So we're thinking about things the right way, and then how will we restructure our research to achieve the objective that we want.
Sometimes it's just as simple as switching the broker and go to a broker with lower transaction costs. I mean, it sounds trivial, but sometimes you go, well, I pay, 20 basis point at this broker and I pay 1.5 basis point at another. That's a huge difference. And this could already be the little change that takes our strategy from unprofitable to highly profitable.
And that absolutely does happen. Yeah, it's very
exactly,
real.
exactly. And research good research will really expose that. And what's also nice is when you do this research in that way, you can really see it. It's in plain sight, and you can go, oh, okay, so it's my transaction costs. It's the brokerage. So if I go to a different broker, I suddenly have a profitable strategy. And I mean, this is probably one of the best and easiest solutions, and it's often one that is extremely powerful.
This is the business of trading too, isn't it? We've got to think of all the other ways to save money, like any business.
Exactly.
So you can't just be singularly focused on one thing. Like any business, you've got to be working with the right partners. And
correct.
So you could move brokers, but you could find a way to net your trades and lower your transaction costs or your turnover for the same, alpha style.
Correct. Yes, it's very, very important and often too much overlooked. I mean, I think.
Sorry, Tom. Yeah.
Yeah. Go for it.
Any other gotchas, I guess, like that?
There are a few. So one is that I think that a lot of people overlook when you trade US equities or US stocks, for example. Generally, on the market open, you have an extremely high volatility, and when you run a trading strategy, and you see this quite a lot online, you get these trading strategies that look extremely profitable, but they trade right on the market open when the volatility is high. And whatever your price is posted in the data set is most likely not the price you can achieve on the open. So in many cases, little things like that, if you're not careful, they can completely change the nature of your strategy. And you have to be extremely aware of that. And so I would really highly recommend people to look deep into this, because especially in the open, the price that you see in your backtests is most likely far removed from the price that you would get in your actual trading. And then, of course, with stocks as well, you've got corporate actions. With futures, you got expiries that are, that can really be dangerous to you come close to, and so on. And I don't know if you remember, but in 2020 we even had negative oil prices in the front contract of crude, and so things like that can be really problematic. And if you build an algo that is used to positive prices, for example, and then you get a negative price, it can really come to bite you in the back if you're not very careful. So
IB had built a whole brokerage that wasn't aware of negative oil prices, if I remember
exactly,
correctly.
it's something that you would never expect, but it still happens. And then, of course, another one that is perhaps sometimes a bit overlooked by people is the availability of liquidity. And so, especially if you trade smaller names, then they can be quite illiquid at times, or very, very, the trading volume is very small, and there's not actually much happening. So you have to be quite aware of this as well, because again, your backtest may not actually show what you would really get in real life. And this needs to be taken into account before you even run a backtest, before you do anything else. And so obviously good research into the things you want to trade really helps to mitigate that.
Yeah, 100%. All right, so then let's get into the backtesting. What happens when we start backtesting? How can we backtest better?
Okay, so again, we talk about people using platforms, and there's absolutely nothing wrong with platforms. They all do what they do, and whatever that is generally very good, and they're usually well built. However, I have actually tested a lot of backtesting platforms myself, and I found that most of them have flaws, and they're not actually reporting things correctly. And that's nothing bad, but you have to be aware of it. And the other issue is that they often make assumptions that we're not aware of. They may just happen somewhere in the back end. You don't even know, and they give you results, and you won't be able to really tell whether the results you see is really the results that you should be getting or not. Now, coming back to the idea of hypothesis testing, we're not here in the business of building a perfect backtest that perfectly reflects what would have happened in history. I mean, it's nice to have, but it's not really the goal. The goal is to verify that whatever strategy we want to deploy live has merit and will actually get us to fulfill our investment goals. So we need to be aware of that straight from the outset. Now, in terms of actual backtesting, I use several levels of that. So I don't just use one backtest. I usually start with what I call a vectorized backtest. They're very simple, very extremely fast. You can run 20 years of data on, let's say, 100 different stocks in a tenth of a second, also, or less than, actually more like a 50th of a second. So it's very.
And we're
quick.
talking about in Python, just to be clear.
In Python, yeah. You can build stuff that is extremely fast, and it's nice because if you want to do quick tests, run through different parameters and so on, these tests are really good, and they're not actually bad in terms of the results that they are giving. That the results will not be perfect, so they have certain simplifications that you need to make, but they will give you a reasonable idea of what's achievable. And once you've done this, the next step usually is to have something that runs in a loop, so you can basically run your trading signals through a looping system. And there's a few advantages to that, especially if you have entries and exits. The looping system will give you a better idea of how to deal with the trading costs, because in a vectorized backtest sometimes the notion of an entry and exit is not as clearly defined. In a looping backtest, you can basically better control your turn over all these things, and so it gives you a more interesting perspective. But the issue with those is they're generally a lot slower than vectorized backtests. So you're basically a bit limited in terms of speed. So you want to really do a lot of the work in the vectorized backtest beforehand and then check it. And then once you have that, there's two things you can do. You can just run these loop backtests on whole portfolios, or you can have another backtest that basically takes the individual results from your loop backtests and then runs another backtest basically on doing all the portfolio management. Usually there's a better way to do it, because if you have all the portfolio management, anything in one backtest, it becomes fairly complex and it's very error prone. And to actually separate these concerns can be very helpful, because it makes everything much clearer and simpler.
Yeah.
And once you've done that, you want to go and effectively build some event-driven backtest that more or less mimics the real world. And so what I often do is my last backtest. Effectively, what I do is I have my file, and the data are effectively trickled into the backtest just as the market messages would come from the exchange or from the broker. And then what I can do is I can take that backtest and then effectively just swap out the data source going from files to the broker API and run that live. So it's kind of usually the thing that you want to do last. And the advantage of that also is then it's much easier to compare your live results with what you would have expected from your backtest and see if there's any discrepancies. And if there are, it's much easier to identify what the problem is. So that's, I would say, the 3 or 4 levels, 3+1 levels of backtesting that I generally use. Once you've done backtesting, there's a few other things that you can do sitting on top of that, and I'm sure you are familiar with a Monte Carlo methods. The interesting thing here is there's actually quite a wide variety of things you can do in Monte Carlo that give you some really interesting aspects of the robustness of your strategy. For example, you could take the signals in your strategy and just swap them with random signals. So if you have long short, you just add, or you just swap them out and give it whatever random signal and see what it does. Usually it should not, at least on average, it should not produce any profitable strategies. And if it does, that may actually mean that your backtest is wrong, because normally in mathematics you say that random strategies are generally, or there's no way to make money from randomness, so it shouldn't be profitable. Now, let's say you have a long only strategy, and then you trade, say, the S&P 500 or the SPY, then you will actually get a positive outcome regardless, because it's just generally biased towards positive returns. So you have to be obviously aware of how, what you're dealing with. But normally you would do this for, let's say, long short strategies. And then, you can do things like taking the returns of your strategy and then just drawing random samples of them and then recombining them and then see what that gives you on average. So if often what happens is random sampling, some of the really extreme returns or the extreme drawdowns are smoothed out, but then you get new drawdowns and so on. And so what you want to see is that on average, those random sampling tests will still give you some reasonable result and not completely fall over, because that means your strategy is very fickle and not particularly robust. Then you can do some what you call random parameter permutation. You can just randomly change your parameters, because the parameter set that is ideal in the current period may not be ideal in the period forward, and there's another ideal parameter set. But you want to make sure that even if you have your parameters in a reasonable range up and down, they would still hold up as a strategy and not completely degenerate. That's also a sign of a robust strategy. And then I guess things like excluding the top and bottom N 10 or 20 or whatever returns, see what the strategy does when you do that, is also quite interesting. So all these things can give you interesting insight into the nature of your trading signals, of your strategy, and help you to make good decisions on whether you want to proceed with a particular signal or not.
Absolutely. So, yeah, we're trying to build robust strategies and avoid overfitting. All of those traditional methods, we want to, I guess, as we said last time, fit as many of them into the process as we can, as efficiently as possible. But we've got to be mindful. We've got to know the tool. We've got to know which one is for which purpose. But they're all of value, whether it's walk forward analysis and Monte Carlo and variance testing and multi-market testing. All of these have their weight. And I guess the really critical part as we build up our skill set is knowing what's the most relevant test for the research that I'm doing. Because I guess the overfitting, I said earlier that it was offline, that it was how important it was, but you said, well, you can never completely avoid it.
There's usually a middle ground. And you can, of course, reduce your bias by a significant amount. And, there's techniques that are generally well known. Walk forward analysis is one, and you're really minimizing the amount of optimization that you do, or doing the robustness testing that I previously mentioned on top of an optimization. And another one that is also, I think, quite important is to reduce complexity. So I sometimes see people trade strategies that, well, they seem to be good in the backtest, but they are so complex. They have so many elements and 25 parameters and so on. And, my PhD supervisor used to say, with 3 parameters, I can fit a lemon or something. And with 4, I can fit a car. And if you have 20 parameters, then we're already getting very much into a very complex territory and overfitting territory. And having a conscious simplicity in your strategies can actually be a good thing. And it doesn't mean it's overly simple, but it's consciously simple. And sometimes, if let's say you take a parameter out of your strategy for the sake of a little bit of performance change in the backtest, is much better than leaving it in there. And like, you get a better looking backtest, but it will actually reduce the robustness going forward in live trading by a significant amount. So it's these things you got to be very aware of, and once you're aware of them, it will greatly help your out of sample performance. And one thing to always remember is, we're not in the business of producing good looking backtests. We're in the business of producing good looking live strategies.
How important is that? That's such a good point too.
Yeah. So good looking backtests, great, but it means nothing. I mean, I can produce 1,000 good looking backtests in 5 minutes. That's not the point. So we really want to avoid really too much of that.
I was having a discussion with a friend today about the all-important reality of actually living through trading, living through drawdowns, living through the whole experience. And until we've done that, Unfortunately, I don't know if we ever can actually learn properly the right approach, because until that happens, it is just the human mind and the optimism and probably the the greed, if you like, to there's going to be a natural desire to look at the best looking back test, as the one to run, as the one that's going to make us the most money. But the reality is it's the out of sample performance. So the back test is just an indicator and another part of our strategy stack or our research stack. And the objective is out of sample performance. And so we've got to be very mindful of particularly risk management, which I do want to move into next. I think that's the kind of icing on the cake here. But when we've got this approach, as you've been talking to all this time, and as we said in part one, we're starting to think aright, and so it just opens up our our breadth and our capabilities as well, because we could do this research and we could come up with a strategy that on the surface wasn't necessarily profitable, say, but it could have a role, or that research could have a role. We would learn how to tweak it. We would learn how to build something to fit our strategy for a particular purpose, such as to produce some crisis alpha or whatever it might be. So if we've got that right process, then we waste a lot less of our time, because we can actually utilize that research. We're constantly learning, building our skill set, and there's often a way to use that in the next step, even if on the surface it wasn't like the perfect outcome.
Correct. And as you said, construction of portfolio and position sizing is a crucial part of that.
Yeah, okay, Tom. So let's go there. I think the icing on the cake is the portfolio construction and risk management overlay to all of this. So it's not just about building an individual strategy, it's about creating a portfolio. What are some of the key aspects to, building this into our process?
Well, first, you may remember that in the previous podcast, I talked about the coin flip and the 51 to 49 bias coin, and how crucial it is, even if you have a known edge with a known volatility, to size your positions correctly. And if you don't, the margin for error between actually making a profit or a loss is so small that it's of vital importance to get this right. And so the same, I mean, whether you use a coin flip or a trading in the markets is very similar. Even if you have an edge in your strategy, but you get the position sizing wrong, you may still end up producing a significant loss. And so really, this is the bread and butter. This is the real cornerstone of what you're doing. And this is one that most people really miss. Once we have our trading signals, once we understand what we want to do, we really need to sit down and think about how do we manage our positions correctly and our strategies. And I already touched on this before. Let's say we have several strategies and they're all perhaps returning quite well, but they're very highly correlated. That is probably as good as just trading one strategy, and it doesn't really help to add more of these. What you actually want to add is strategies that have much lower correlation to all the other strategies, and nevertheless returning at the right times. And so if you can do that, then the performance of your overall portfolio will just be much, much better. And how can we do this? Now, portfolio management is really interesting, because what it does is it elevates our thinking from, I would say, a one-dimensional system, which is along the timeline of your trading system, to a two-dimensional system where you then have all these in parallel. So you end up having to think effectively in a more elevated sense. And suddenly, instead of thinking of what in mathematics we call a vector, you have to think in terms of a matrix. Now, this sounds a little bit daunting at first, but interestingly, if you program it in general, it's just purely adding another dimension to the inputs you do, and doing something like applying transformations to them, such as covariances and so on. So if you haven't heard about this before, don't be so worried. This is something that is relatively straightforward to learn, and once you wrap your head around it, it's phenomenally powerful, because it really takes your trading and what you've done before, which was potentially quite good, to like really on supercharge, and really makes it much better. And without it, you will never really never say never, but you're less likely to get to that next level. And so simply, if you want to go to the next level, take it to the next dimension. That's the way to do it. It's like when you live in a 2D world and there's a barrier all across your 2D world, the only way to get around this is to go 3D, right? You can't stay in that world. You can never get beyond the barrier. So in a sense, I guess that's a little bit similar. And so there's a few aspects of that we have to think about. One is our risk appetite. So I talked about this before, the difference between, say, Kelly formulation and mean variance. Well, one is more the gourmet style position management, and the other one is the gluttony, where we just go for the maximum return, but we don't care about the risk we take, because we're just happy to lose as much as we win. So they're like really the so very coarse-grained approaches, but they're quite important with the view of what we're actually trying to achieve in our portfolios. We really have to actually think about them. And then another one that is very important is the idea that we have a good breadth and diversification. So again, coming back to the idea of, or the golden rule of active portfolio management, we have the square root of the breadth. And so breadth is only good if we are diversified enough. So all our underlying strategies and products have enough diversity that they're actually contributing to the breadth. If they don't do that, then they're not even worth bothering. We can just achieve this with one and the same thing. So this diversification and breadth idea, again, also called a free lunch by Harry Markowitz, is of vital importance. And then I guess one of the considerations is the idea of catastrophic losses. And again, that is an interesting one, because what I see often with retail traders is they run a single strategy, they apply a stop loss when the strategy goes bad, and that's it. And when you actually do this, when you run stop losses on single assets, single strategies, what you find is that most likely the performance of these strategies will never be as good as if you actually let them run its course. Effectively cut your losers, let's say cut your losers, let your profits run. But in trend following, obviously you have these things as well. You cut your loser, but then it's part of the strategy and it's not part of risk management. It's really important to make that distinction. So stop losses as part of the strategy are different from stop losses as part of risk management. And so stop loss as part of risk management can be very dangerous. And personally, I prefer to have them, but only at the highest level, when I really see that my whole overall portfolio starts to catastrophically fail. Toi, this has not happened so far, but having some backstop there is definitely useful. But it's also good to be aware that when you have this, for example, in every single strategy that you run, that can really be quite detrimental to your overall performance. So I'm not saying you should do one or the other. I'm just saying it's worth considering what you are doing there, and thinking it through, testing it sufficiently, because really a stop loss is just another trading signal, if you will, and it should be treated as that. Often people, they research trading signals like there's no tomorrow, and then they just go, and then we put a stop loss at minus X percent without any consideration. So this should be very carefully considered as well.
Just to
And
clarify, Tom, are you saying that to consider the difference between putting stops at a strategy level versus at a whole portfolio level? Have I understood that correctly?
yes. Well, two things. Using a stop as a risk management tool.
Right.
So there is, as I said, that you look at trend following, and trend following. The strategy is that you follow a trend or you cut it short if you make a
Right.
loss. But that's not strictly a risk management tool. It's part of the
Yes.
strategy.
I
But
see.
if you have a strategy and when you say, well, if it starts failing catastrophically, I just cut it, then it becomes a risk management tool. That's very different. And
Yes.
so
Okay.
it's important to understand that distinction and not confuse the two. There's quite a big difference between them. And so I would say that there is no right or wrong. Don't get me wrong. I'm not saying you should do it this way or not that way, but your decisions on what you do should be based on sound, solid research. And it may turn out that having stop loss everywhere is the best thing for whatever you're doing, but you wanna make that decision based on evidence, not on narrative. And if you can do that, then that's absolutely fine, right? I said a lot of research suggests that's not necessarily how it works, but it could work like that.
I was just going to say, I guess that lends to the next point of when we're constructing portfolios, we can now start to think about catastrophic losses, which is another key part of the thought process now, isn't it? Was where when we're at the portfolio level, we're trying to minimise the possibility of these catastrophic losses. It's a really critical part of the portfolio build.
Absolutely. I mean, like stop loss would be one thing, but there's actually other tools that are most likely to perform better. And one is hedging. And so hedging can be done in various ways by mixing long and short volatility strategies, for example, or using options for hedging or options strategies, and so on. So sometimes these are way superior to just putting on a blunt stop loss. But again, that has to be based on research and the considerations, looking at what you're actually trading, what you're hedging it with. And then we come into this area of so-called downside correlations, where you basically look how the correlation changes as we get into a correction. Often, the correlation increases when we get into corrective markets and so on. So these things are worth considering. And again, this sounds complicated, but once it's like learning a skill. When you play chess, you might know 50 different openings, and the more you know, the better you get. Or other skills, or a musical instrument, you play a guitar and you learn classical music, and then you learn jazz or country music or something like that. It just broadens your skills and your abilities to deal with whatever comes your way. Let's say you play as a professional musician, and you play in rock bands, and suddenly you're faced with country music. And if you have the skills, you can just do it. If you don't have the skills, you get lost. So it's just really important as you go, and this is not a process that you do from one day to the next, but as you go and you learn, you just broaden your skill set. And this is really the business of trading, just like in any other business. Even in the trades, you improve your breadth of skills, and with that you're able to take on more and more complex challenges, but also generate higher returns. It's
Really
very much like that.
important. Yeah, really important to survive long enough to be involved in the business of trading. And
Correct.
that's this critical first step that we all, I think, could change if we could go back, because we were all too arrogant. But if one starts with some solid foundations, invests in skilling up enough first to do things right, and then get some simple things going that are as robust as heck as possible, then we maximize our chances of surviving long enough to increase our skills. It's just such a simple thing. It's hard to hear. I've said it before, but it's just so true. If you're interested in trading, if you can first concentrate on survival and deployment of, simple strategies, let's say, don't do anything too silly, and try to stay around long enough to stay in the game to be able to then become a master.
That's absolutely right. And actually, you learn more starting simply, but actually starting, than overdoing it, learning everything, getting lost in that, and never actually get any feedback from the market. I mean, these days it's nice that you can, for example, deploy crypto strategies on very, very small amounts of money. And what's nice is you get actual feedback from the market if you do it, even just to learn to do it. It's incredibly powerful. Or you trade FX on a really small account, something like that. And this feedback is phenomenally valuable because it really shows you whether you're doing something right or not. And there's never been a better time really to do this than now, because markets were very much unattainable for the broad population, but now it's not like that anymore. And if you actually can put on a small strategy and manage to keep it alive and not not crash it, then that's already a huge step at the beginning. And people underestimate how good this is, and they think, oh, I just made 3% in 3 months, but you actually made money from that strategy. That's pretty impressive. And if you then look and see, well, how can I improve this? What am I doing here? Blah, blah, blah. And you actually have the research tools at your disposal. You have a much, much higher probability of actually moving your trading business to the next step, and so on.
Yeah, that's it. My little 10-minute video on the front page of my website says exactly that. In my first 2 years when I was being mentored and actually started getting things right, the returns were not stellar, but it was all the stuff happening in the background.
Yeah.
That was like, an iceberg, right? The vast majority of the work was happening underwater. And it was just taking that time to come to the surface. And but it did actually sort of take me 2 years of just being really ordinary, but not dying, to get to the next step.
We've all had that. It took me quite a while to be consistently profitable, and I I've been okay profitable, but there is one thing. One thing is to make some money, and another thing is to have consistency in that. And as I said also before, you start to build an intuition, which tools to use and what might work, which becomes better and better over time as you keep doing it. And I think this is quite important because it also speeds up your research time significantly.
Yes.
And in a sense, you want to get there. You want to effectively look at what you're up against, look what you want, and then intuitively pick the right tools, take the right steps without too many diversions, and get straight to the point. Now, of course, that doesn't always work, but I can definitely observe this in myself that I'm now able to extract value from something I have never seen before much, much quicker than I used to.
Yeah, absolutely. Well, this is a lovely lead in to a conclusion, Tom. The summary of it all is really that we want to be able to really trust our own work, trust the outputs that we're producing by focusing on having this process and this pipeline. We can trust the output. And of course, there may be some people that got bored with this discussion early on because we didn't come out saying, here's a winning strategy. But if you've listened this long, you've worked out that the winning strategy is probably not the hard bit. And that if you've got this right process, and you can trust your own work and you know your tools, you will start generating these outputs that are desirable. You'll start making money in the market. So let's summarize, Tom. Do you want to just sort of, if you can, I guess, bullet point some of the things that we've covered in summary that just like lead us through this pipeline again. Remind us that there is a pipeline, a research pipeline that that we want to try and systematize as much as possible in order to be able to automate it, in order to be able to speed it up, to do much quicker proof of concept testing or hypothesis testing, discard bad ideas. You know, run us through this again as a bit of a foretaste of things we'll deep dive when we start doing the workshops together.
Sure. Well, first of all, the winning strategy today is not the winning strategy tomorrow, or at least there's no guarantee whatsoever. So we can already start to discard this idea that, oh yes, we just want a winning strategy, because whatever winning strategy I present to you, there's absolutely no guarantee that this is going to be a winning strategy. And whoever claims that is effectively not telling the full truth. So I would say that you can't just say that straight away. But obviously people do, and with great confidence, and I have all respect for them. In my opinion, it's probably a little bit different. Anyway, going back to the pipeline and just summarizing it. Okay, let me think about this a little bit. I guess in a broad sense, we obviously start with an idea generation, and this is often the real fun part, because it includes a lot of creativity, coming up with new trading ideas. And amazingly, there's just so many new trading ideas always coming to my mind and to other people's minds, that it's just an endless stream of things. And initially, when I started this, I didn't have that many ideas, and what I did is looking up other people's. But then over time, you start really finding your own. And then, of course, once you've found some ideas that might be interesting, you have to look, does that fit with my investment objectives and with my portfolio in general that I may already run? So you have to do this a little bit of sorting that. And then once you've done this, you want to do some hypothesis testing, or a little proof of concept to see whether the idea is actually sound and holds up in different conditions, holds up with some randomization and so on. And well, if it does, you can do a bit more deep research. You can run some proper back tests, include trading costs, make the back tests more and more elaborate. And once you have a reasonable confidence, then what you would do is really start doing some paper trading or deploying it on very small volumes, just to see whether it actually does what you expect it to do. So once you're running it in some sort of live environment, you can then go and compare it to your backtests going forward and see if it actually does what you expect it to do, which in many cases is not so. I have had so many incidences where I deployed a new strategy and it was nothing like the backtest, and it just turns out it's this little bit that I forgot in my programming, and it just created something completely different. Of course, there's ways to make sure that this is less likely to happen, and I already mentioned that, but it can still happen here and there. So once you've done this, you're basically confident that your transaction costs are not killing you, your slippage is okay, you're not trading in strange hours of the day, and so on. Then you can slowly start scaling up and deploying it properly and actually trading it and see what happens. Now, always be ready to come in for a bit of a rude awakening. That just can happen, and it shouldn't cause you. It should cause you to be alert and warned, but not necessarily stop you from not doing it. But it should be just a way to teach you a better process, a better research, more work and more learning. I guess learning from your mistakes is always it's a tough taskmaster, but it's a really good one, and that should really be your attitude. Now, I guess the final steps that we don't really need to cover right now, because there are more really when you work in larger institutions, is execution and scaling. So execution generally is complex. There's simpler ways, but it's generally very complex and has a lot to do with low latency, or high frequency trading. And the other thing is scaling. If you have the issue of scaling a strategy up to 10 million, 100 million, $1 billion, of course, it's a good problem to have, but it's probably not something most people at the beginning of their journey will have. So I would say we leave this for later. But I would say overall, this probably sums it up quite well. Is there anything else you might want to add to this process?
I think that's great, Tom. My summary of all of this is that if we've invested in the right process, it's kind of like learning to fish rather than be given a fish.
Correct.
And I can really confirm that you will not be short of ideas. There are ideas everywhere. Once you've spent a bit of time in this, and just listening to this podcast will give you many ideas from the many people that I talk to. So
Yeah.
ideas are not the hard part, but if you can invest in this process, you're building the money making machine essentially. And part of that is you start to skill up. You will start to understand your tools, when they should be used. Understand your metrics. Understand what the Sharpe ratio is. Understand what your return profile is telling you, what it's like when you make money in certain situations, when you lose money. As Lorenz Bensdorp has said, you should know why. You should know when your strategy is going to make money and when it's going to lose money. The more you understand your tools and these metrics, you'll know how to apply the right tools at the right time. And I think of it as building up a sound statistical framework. I think it's frightening that I think there's a big advantage to the background that you've got. Any statistical background just encourages right statistical thinking, and I think the average person is a little more of a gambler. Maybe I'm just thinking of Aussies, but a little more of a gambler than they'd like to admit. And you can't do that when you're running a business. So you
Correct.
have to have a statistical framework, don't you? You have to be able to think in probabilities. You have to kind of know, look, that's nice that you've just, told me that's the outcome from your single back test. But one has to know what to take with a grain of salt, because even the path dependency that you mentioned, like what about the trades that you didn't take? What if the path had been different? You've got to just start to think like that intuitively. You'll build out a sound process for building robustly, testing robustness, and I think the conclusion of the whole matter is that we can draw the right conclusions about the research that we've got. I also like the fact that you've focused very heavily on the fact that it becomes about understanding the risks involved, and the portfolio construction is a really much more important part than many would imagine.
Yep.
And that really the focus is robustness out of sample, not the back test. The back test can lie. I think that's the title of the article I should write with this podcast, is that when back tests lie,
they always
because
lie.
they're just a tool. Just a tool.
Well, they're not like notorious liars, but you should always look at them as such, and take them take whatever they say with a grain of salt.
We want to have confidence in our process, not in the back test. Like a single back
Correct.
test result is not going to give you confidence, but your process can give you confidence. So unfortunately, I've just undermined.
Really,
yeah, I've just
really
undermined
good to say.
Yeah, the vast majority of other people producing content on YouTube and Twitter and Substack and wherever, because this is just not even barely mentioned. But if you don't have that process, you're barking up the wrong tree. And as you said to me, Tom, I guess once you do get there, it looks effortless, but it took a lot of work to get there.
Still a lot of work. I mean, maybe it looks effortless to the outside person once you demonstrate it. But even so, for me, still a lot of work. Markets are changing. It never stops. But that's a good thing. That's actually what makes this business so much fun.
Yeah, absolutely. All right, Tom. Looking forward to the next steps and the workshops. Thank you so much. And yeah, just a reminder that Tom's on Substack, and he did just put a post out recently where he talked about that coin flip example and the importance of being systematic in our investing. It's a really good one to go check out on Tom's Substack, tomstark.substack.com.
Thank you. Very
Thanks,
early
Tom.
days for me, but thanks
Yeah.
so much, Simon. I really appreciate that I could come on here.
Awesome.